Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you have joined us for the Clean Energy and Renewables Conference. The first presentation of the day is from Bimergen Energy. Please note, you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for a one-on-one meeting by clicking Book a Meeting. At this point, I'm very pleased to welcome Bob Brillen, Co-Chief Executive Officer and Chief Financial Officer of Bimergen Energy, which trades on the NYSE American under the symbol BESS. Welcome, Bob.
Thank you. Appreciate it. Well, we'll take it off from here. And thank you, everybody, for joining me today. As was just said, we have just uplisted in the last couple of weeks to the New York Stock Exchange under the symbol BESS. And we're going to talk about Bimergen Energy. So Bimergen Energy, just in, I guess, a summary version, is we build battery farms. These battery farms are on about 10 to 30 acres, but they're very expensive to build. So each battery farm that can produce about 100 megawatts of power is going to cost about $125 million to put in the ground. We have 23 of these currently in our development stage pipeline. We bought these from our current co-CEO, Cole Johnson, about a year and a half ago. He owns about 25% of the company at this point. And Cole is been in this business for over 20 years. So he understands both oil and gas, batteries, wind, solar. And so we're excited to work as a team. The other thing that's happened for us in the last 6 months is we've gotten $250 million worth of committed project equity capital. So even though we just raised $13.6 million into our corporation, that's not where we're raising our money to really fund these over $2 billion worth of projects. That money is being raised on the project equity side through mezzanine debt or just project equity groups that we'll talk about. And also about 80% of those projects are going to be financed with just bank debt, and usually just about 2 points over SOFR. And this is about 2 gigawatts worth of power. So again, 2 gigawatts can generate about $400 million worth of energy arbitrage on an annual basis. So I'm going to go forward here and just talk through 23 projects we talked about. They are throughout the United States. 11 of those projects, though, are in Texas. And Texas is where Cole Johnson and his group reside in Dallas-Fort Worth area. And they really pick the pinch points around the United States, pinch points being where you can put $100 million, $125 million asset. That asset can generate energy arbitrage. And again, it's energy arbitrage because we're actually buying the energy from the utility company through their substation and selling it right back to that same utility company. So it's when there's plenty of energy online, as we all know. There's certain times of the day that you have peak hours, and there's certain times that you don't. So when there's a lot of energy available, we buy it for very low prices. And when there's energy needed on the grid, that's when we sell it back to that same utility company. And as I said, on an average basis, when you do a 100 megawatt project, that 100 megawatt project is going to throw off about $20 million a year in annual arbitrage. So these projects have gone through the development stage, again, through the feasibility studies, the development process, and getting to what's called RTB, ready to build. And where these projects get to the point where they're ready to build, what they need is financing. So that's where all these projects were when we bought them about a year and a half ago. And we've been working through the process of getting the financing in place. That's what we just talked about, having $250 million worth now of committed financing on the project equity side, mezzanine debt side, allows us to get over $1 billion worth of actual debt capital. The reason this is a model that's very sustainable and it makes a lot of sense is that the fact that you have a rising power demand, really from data centers, AI use, et cetera, that's just expected to double between now and 2030. The intermittent renewable power supplies are trying to keep up. and that's wind and solar, putting more of those in place. But what's happening is there's a traffic jam. So the grids can only take so much power. So there's several terabytes of power during each year that's being curtailed, meaning the power companies have to tell the power producers, we can't take any more during this time of day. Well, guess what? That's exactly when we take it on into our batteries, we store it, and then we put it back on as soon as it's needed. And this doesn't happen just once a day. It happens several times a day where we're doing this energy arbitrage, knowing that we can buy it very low. And then when there's a spike and there's power needed, we put it right back onto the grid. There's a deepening duct curve that's been kind of monitored and modeled over the last 15 years. And it's just showing the incredible difference between supply and demand. So our role is, like I said, tying into the power grid. Now, we don't care where the power comes from. It can come from wind, solar, oil, gas, wherever that power comes from, that electricity that you and I need goes onto the grid. The grid itself is where we connect, and then we send it back out to the grid. Like it says here on the slide, we buy low, we sell high. Again, it's a very simple business model. It's that energy arbitrage but it does take a lot of cash to get these into the ground. We also put into place what's called tolling agreements. A tolling agreement is guaranteed revenues from the large financial hedge institutions. One that we're working with right now is Goldman Sachs Commodity Desk. So we have an infrastructure in place where we'll be using them as our tolling agreement. And the reason why a tolling agreement is important is, one, it does de-risk it for us, because now we have guaranteed revenues that are going to cover all debt service, all debt payback. And again, this isn't just because we want it, but it's also because the guys that are writing the $100 million checks per equipment, then they are requiring us to have a tolling agreement in place so they have that guarantee. One thing I should say about the tolling agreement, it is a floor, so a guaranteed revenue stream, but it also has a sharing mechanism. So above that floor, we actually share in a 50-50 scenario. So just round numbers, if it's a $12 million floor, then you have, and you're gonna end up making $20 million annually on that project, then you're gonna share in that 4,000 each. So we'd end up with 16 and they'd end up with 4. Here I want to talk about the strategic partners, because this is an important one. We have $250 million that I talked about up front. The first $50 million is with RelyEZ. RelyEZ is a China battery manufacturer. They do lithium, and they are also starting manufacturing here in the United States for obvious reasons of tariff and investment tax credits. One thing I didn't mention up front, and I should have, is the investment tax credits is the reason that this pencils out really, really nicely. And that's because when you spend $125 million on a project, and then you want to move forward with that, as soon as you get it operational, which is usually 9 months to a year, you now can apply for the investment tax credit. You don't have to wait to use that investment tax credit. You actually monetize it immediately. You have a tax equity partner in place. So just using round numbers again, $125 million project can get up to about 50% investment tax credits. So saying $125 million project you put in place, you can turn around, get $60 million investment tax credits that you monetize. You now have taken out your original $25 million that you had for a equity partner or mezzanine debt, and then you pay down your $100 million debt that you got for your equipment. So you now have only $65 million against your $125 million asset that's producing you $20 million annually. So again, you can see that the debt service is much lower than it would be if the investment tax credit wasn't there, and also the payback period. As I was talking about RelyEZ, the $50 million commitment from them, they put $10 million in place into a joint venture immediately. We are moving forward with RelyEZ. We just announced just recently that we have 8 projects in Texas that add up to about 80 megawatts themselves. And again, that project now is moving forward with the RelyEZ as the mezzanine debt in that. we'll be bringing on our long-term debt partner and putting out those construction bids almost as we speak here. The other piece here is Cox on the far right. Cox is a $200 million commitment. And again, they will be a equity partner that, of course, unleashes about $800 million worth of bank debt. So between the two of them, we'll have $1 billion to put into projects. EOS is one that is on our slide, but also we just announced that we're moving forward with a project with them called Redbird. They weren't in our original $250 million numbers because it's just moving forward, and it's going to be a great relationship. EOS is a battery manufacturer out of the US. They are zinc bromide. The project, like I said, we're moving forward with was one that we had moved along through our development stage, and it's called Redbird. It's also in Texas. So we expect that to be up and operational here within the next year. Goshen is just another lithium battery manufacturer out of China, but we were working with them with supply chain agreements, cost structures, when Cox came to us and said, hey, no, we have a great relationship with Goshen. We have several gigawatts of power around the world using their batteries. And so we were fortunate enough that they brought that to the party for us. And again, Cox is not Cox local, it's Cox out of Spain. It's called Cox Grupo. So we talked a little bit about the long-term tolling agreements with Goldman Sachs commodity desk, which is very important to us. The other piece that's important is to have a scheduler. Our scheduler is Tenaska. You could have your own in-house trading desk. And again, this is what I call day trading for energy. And so Tenaska does that for us. They're the ones that actually have about 60% of the market right now in Texas. And our groups have worked with Tenaska for many years. And so it's going to be a great relationship for us. As everything, they take a small piece of the pie. And so it's great to have a bunch of third parties. We don't expect to have to grow our in-house group. We only had about $2.5 million last year in corporate expenses. This year, we expect it to only be around $3 to $3.5 million. So as you can tell, with the 13.6 million that we just raised, we have a lot of runway, even if we weren't having revenues come in. But to speak about that, we will be having revenues come in, because even though operations take 9 months to a year to come online, we also have development fees. That meaning that when we take our projects and put them into a joint venture to move forward with our partners, we actually receive development fees for those projects. The negotiations right now are about $8 million per 100 megawatts. So again, if we can get 300 megawatts up and going into production here during this year, which is our goal, it's about $20 to $24 million worth of revenue you'll see hitting our books this year, also cash flow. What that also means is we'll be profitable in 2026. So it's a great way to start out the gate here. What I wanted to show on this slide is just, like I said, Project Redbird was kind of our first one and closest one, now being taken on with EOS. We have key partners here to the right we had in place. Again, now the battery supplier definitely is going to be EOS, but we have all the interconnections. We have the EPC, which is the engineering, and the, then you also have the tax equity partner that, like I said, they'll take the $60 million pay down. We'll use that to pay down our debt with that. You also have Goldman Sachs and Tenaska that we've already talked about. The key partners are important because these are all the pieces to the puzzle that not everyone has. So that also allows us to take on new developments. So instead of just using our pipeline, we are shown weekly now new developments that don't have all the pieces of the puzzle in place. And the fact that we have everything in place, ready to rock and roll on all of these projects, we're getting shown these, and you'll see many more projects come under the Bimergen umbrella. So again, when we talk about a typical 100 megawatt, this is just to show you what I was talking about earlier. $125 million of capital is what it would be typically take. And as you can see here, almost 70% of that is equipment, battery, and interconnection. Well, that's important because your project equity guys and your bank really like the fact that 70% of their money is going to physical assets. Company management, again, it's important, as many of you know, to trust the management, understand that they know what they're doing. And this is a been there, done that team. So again, we've got Ben Tran, who's the founder of the company. We also have Cole Johnson, who I talked about. He's got 20 plus years experience really taking these things across the line, turning them profitable. And we're excited to work together as co-CEOs. Myself, and again, Cole's done this project financing, corporate financing all himself in the past. So he understands every piece of the puzzle when it comes to this. Myself, I've got 30 plus years in capital markets. I've taken several companies public. You can look at my bio. It's been all across the board in different technologies, etc. So this is my first time in energy, but I really am excited about it because the business model on this is so simple and it's so easy to make money as long as you know what you're doing and you have good capital partners. Cole also brought his team with him. He's got several gentlemen that have been there, done that with him for several years. The other thing that's important are the relationships that all these guys bring. They are priceless because, as you can imagine, when you have a group that has written you a $100 million check before, it's much easier for them to write you a $100 million check this time when things line up. On the balance sheet, very simple. The total assets is $23 million. Again, $22 million of that is the stock that was given to Cole for his projects. So that's where the majority of the assets are. Now, one thing that's, as you can see in here, we have offering proceeds not in that 23 million. So again, you're at about 36, 37 now, with the majority of that being cash. The other thing I should mention too is the $22 million worth of intangible assets that we have for these projects really is undervalued because of the fact that it's on the balance sheet at that $22 million. When you go through the math and you say, okay, for each of these projects, it looks like they're going to get about $8 million worth of development fees. So you do the math on that, you're talking about $150 million worth of value just in development fee income. And again, that's really important when you're looking at, okay, it's on our balance sheet for 22 million. So there's some good gain there. The other side of it is it's not showing up yet in our market cap. So when you look at the market cap and we're at that somewhere between 20 and 30 million, then you know you've got a long way to go to get up to just the $150 million worth of value on just the projects that we have currently. And that's without operations. So when we talked about getting these operations up and going by the end of over the next 4 years, having these 23 projects, like I said, will bring in about $400 million worth of annual income. Then you can see that the value of this company is going to be much larger than it is today. Oh, I'm sorry, I forgot to talk about the cap table. Very, very clean. And then we have common stock outstanding of 7.3 million shares. We have no convertible debt. Now we have tradable warrants that are out there. And those tradable warrants, again, are about 3.6 million tradable warrants at the $5 price. And then we have just insider options. So with that, just going to go through the investment highlights, if you will. And really the portfolio of 2 gigawatts worth of power is important because having that in place, having that pipeline really gives us the opportunity to grow very quickly. And as I said, even though this says 2 gigawatts, we really hope over the next 4 years to put at least 4 gigawatts in the ground. So doubling the amount of income that we can bring to the bottom line. And that'll be through the projects, just like the ones we just announced in Texas. Those weren't in our pipeline that we're working with Rely Easy on and that we bought from Agreco. It just because it made sense, they were ready to go. We had all the pieces of the puzzle in place. And so as it says in our press release, we'll be able to have some of those up and operational by the end of this year. And then the other pieces to that will be up and operational in first quarter next year. The stable contracts that guarantee revenue for us are very important because it does de-risk it for our debt partners, but also for our shareholders. So we're all guaranteed that we're getting the revenue that we deserve for these projects. the ITC credits, as I talked about earlier, very, very important. And again, they have been set up now. Both sides of the aisle are really in lockstep that batteries really need to be in place, because you can put all the renewable energies out there, but if you don't have a battery that's really balancing that grid and making sure that the power is there the right time of day, it's just not going to work efficiently. So that's why both sides of the aisle have now agreed, and they put the investment tax credits for batteries out till 2033. And again, once you get it qualified, that actually means you're out to 2036. And we would expect that in the future to get even extended beyond there. We talked about the $250 million worth of capital. And again, with EOS added in there, it's closer to $350 million worth now of the mezzanine or upfront project equity capital. We already have the 10 million in from the RelyEZ into the joint venture. Our second 10 million will be coming in from Cox as soon as the final definitive agreement with them is complete. Key relationships, again, we talk about these engineering, purchasing, and construction contracts. We're working now with some really good construction guys that Cole and his team have worked with in the past. They'll be kicking off the new projects there in Texas very soon. And again, the rapid growing need and sustainability of this model is what's important to all of us. The fact that there's going to be more and more need for batteries and really balancing the grid, just because you have the tailwinds of the need for energy. So this electricity isn't going to go away, the need for electricity. In fact, like I said, it's going to double between now and 2030. So we really expect to step this up over the next 4 years. With that, I'm going to look to see if we have any questions. And again, this shows you my contact information. So if you do need to reach me after this, I'm very available. Okay, first one says you've now proven this, the simultaneous acquisition and financing model with a Greco ERCOT South portfolio. How repeatable is this playbook as you look at it? And the answer to that is very repeatable, because again, the fact that you have all your pieces of the puzzle in place, and it becomes a cookie cutter, if you will. You bring in projects, you get them built, you get them into operation. And the fact that we know the pricing out there, what we should be paying for projects and what it's going to throw off. It's important for us when we look at a project, we want to make sure it's going to IRR in the high teens, because we don't want, it's like anything else. You have all these options. You really need to weigh your options and do the one that's most economically sound for your company. The other one is what are your thoughts on the LFP versus zinc cost, safety, performance? And again, somebody there is asking the question between lithium and zinc bromide. We have relationships with both. The lithium, like we said, we're working with RelyEZ on that with their lithium batteries. We also have Goshen with their lithium batteries, and also Lithium, who we're working with. And again, and then you have the zinc bromide. Again, both have their pros and cons, and it really depends on the project itself as to which one is going to work best for you. Zinc bromide is a more expensive, but it also has some upside to it on the long-term basis. So we'll look at that on a project-by-project basis. Next one here, with AI data centers demand now a key part of your messaging. How is the potential hyperscale and co-location customers reacting to the idea of Bimergen as a dedicated flexible capacity partner? Right now, that is a possibility. It's not something that we are focusing on right now, because we have all of our projects right now are kind of located right outside rural areas where we can tie into the grid. We've identified these over the last 3 years as being very high income producing on the arbitrage level. So we can co-locate, and that's something we can do in the future if it makes sense. Let's see. Okay, is there an expected timeline when development fees come in this year? And again, it will be, it depends on how the project is laid out, because a lot of times these development fees come in over the year. So we have some that are set up 40% up front, 30% at NTP, and then the remaining at COD. We have some set up that are 20, 40, 20. So it really will be over the year and when those development fees will come in. In fact, on one of them, that part of the development fees has already come in because we put it into the Rely Easy Agreco. So we already received that cash for that when we did that, and we just announced that this week. So the initial development fee payment has already been received. Do you have any other projects with EOS other than the Redbird? Well, what I can tell you is we announced Redbird, and we expect to do other projects with EOS because they're a great partner. And again, you know, they have the supply chain that they can work with us on. And so having a priority supply chain of their zinc bromide battery will be very advantageous for us. Okay, let's see here. How much community buy-in is required? There's been substantial resistance to large BESS projects in the Northeast. Wondering if your experience is different in Texas. Well, right now, Texas, you know, when we put our projects in those areas in Texas, it's known, it's expected, you know, the permits go through, and it's because there's a need. Texas has an issue down there, and that's why we have 11 projects that are earmarked for certain areas in Texas. And so it is very much the ERCOT area for us is going to be very key, and you know we're a needed project. Now, when it talks about battery versus like solar, a solar farm takes up much more land and is actually much more intrusive, and so that's why we've kind of focused on just battery. So we're not getting as much pushback as you would if you were doing solar. You announced roughly $250 million in strategic capital commitments for project equity and JV financing. Much is already active in deals like the Agreco portfolio. What is the realistic development throughput that the capital base can support over the next 24 to 36 months? Our goal is, I think I mentioned earlier, about 300 megawatts we'd like to get up and moving this year. Again, next year, our goal is to get all 2 gigawatts of our current pipeline done within the next 4 to 4.5 years and have it operational. So as you can see, we're starting slow with 300 this year. But again, during the second half of this year, we'll start some other projects that will come on during 2027 also. So if we say we do 300 this year, then we do another 500 this year, and then we just keep ramping. And so that by year 4, we have all 2 gigawatts complete would be our goal. How am I doing on time here? I'm really excited to talk to you all. It looks like that kind of wraps up our questions. And to wrap it up with you, I really appreciate everything that you guys have spent your time looking at this presentation. We're excited about Bimergen, again, BESS on the New York Stock Exchange American, and it's going to be a fun ride, guys. So thank you for attending.